Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validity Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validity Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital or Sunpoint Investments.
So Matt, today we're talking the 4% rule. And this is a really interesting discussion because this is all over the place. Whenever people talk about retirement and they talk about withdrawal rates, we always come back to Bill Bengen's research and what he did in that paper and this idea of the 4% rule. And I think a lot of people maybe get some things wrong about this or maybe over rely on it relative to what actually happens in the real world. So we're just going to talk through a lot of issues. We're going to go through the research first, and then we're going to talk through how we think about this in the real world managing money for clients.
It's a rule of thumb, people. It's a rule of thumb. It might work. We might find out it gives kids cancer in 40 years. Like, who knows? It's a rule of thumb. It's actually a pretty good rule of thumb, and that's why we hear it so often, and that's why it hasn't gone away. But much like wondering if eggs are good or bad for you or whatever, it's just one of those things. It's out there. You should have an understanding of some of the nuances before you decide to make it your religion.
And what I think is good about rules of thumb, like I was talking to one of my family members who's going to retire very soon recently, and it's a good way to give people like a general idea. Like obviously everybody should go talk, if they can't do the financial planning themselves, they should go get financial planning because it's way more detailed than this. But in a general idea, if someone comes, if you're talking to someone and they're like, well, I got $1 million, like, what can I spend in retirement? Well, around 40 grand is probably a good thing. And, it's a good rule from the perspective that if someone starts with that and then they're like, well, actually I need to spend 100. Well, now you're not in the vicinity. Or if they say, well, I have to spend half that, you're probably in really good shape. So it's kind of like this barometer to see where am I relative to where I should be, like at least in general terms before you start on the planning part of it.
The way that I like to explain exactly what you just said to people when they're encountering it for the first time, when they've never done the math, when they've never even, or maybe they've heard of the 4% rule, but they don't exactly know how it applies. They haven't even calculated 4% maybe yet. It's, in simplest terms, we don't know what the markets are going to do. We're going to talk a lot about capital market assumptions and realized returns and all that stuff, I'm sure, in this conversation. But if you take all the things that you actually can't predict and you just go, I'm just going to neutralize all of them to start. And I'm going to imagine I had all my money and I put it in a piggy bank, and I need that piggy bank to last for some period of time. And just in pure simple math terms, it's like, okay, 25 years. The 4% rule says if I'm just taking pennies out of my piggy bank jar and I do it the same quantity every year for 25 years, at 25 years, there'll be none left. And so the 4% rule is just a general concept, says before we even get into any of the things that we can't predict, that like this in a perfectly stable environment gets me about 25 years. And when Bengen wrote the paper, that was not all that far off of what the average retirement lifespan was intended to be, the average retirement period. So as a rule of thumb, just passing that basic logical test of if I start with this and if all the things I can't predict basically stay static, that's a pretty good starting block. It's saying, is the thing I did yesterday probably an okay strategy today if it's not causing me any problems, which is where we differentiate. Like if I ate a reasonably healthy diet and I exercised and I've had no health risks, probably continue that into the future. If I'm smoking a pack of cigarettes a day and I'm noticing I'm getting a little bit winded when I like get in and out of my chair, like that's probably a bad indication. The 4% rule fits into this thing. Pay attention to what's going on around you and maybe you won't die.
And I think where people get in trouble was where they think this is like some hard and fast thing. So I'm going to go to Matt, basically. I'm going to say, Matt, I've got $1 million. You're going to get out your HP 10B. You're going to multiply it by 0.04. You're going to divide by 12.
My BA2 plus.
Oh, okay. Sorry.
Don't forget the plus.
One.
This is the business analyst edition.
I was always an HP 10B, but anyway. So you're going to multiply by 4%. You're going to divide by 12. Basically, you're going to be like, all right, here are your monthly withdrawals. Call me back in a year and we'll make your inflation adjustment. Go about your life. You're not going to run out of money. I mean, if you think about it that way, then that's not what it's intended to be doing. It's not like some hard and fast thing where you're like telling your clients to like start withdrawing 4% consistently every month. You're going to inflation adjust it every year and you're going to move on with their lives. When you use it that way, I think that's where or when you think about it that way, that's where you get in trouble because the world changes. There's all kinds of things that happen in retirement, both from the spending and the market perspective that can change this thing. it's a good rule of thumb. It can't just be implemented that way.
Yeah, we're describing calculator or spreadsheet problems, and you can't equate a spreadsheet problem to a life problem. I can take a life problem, I can describe it on a spreadsheet, but I can't take a spreadsheet problem and just like assume life is going to follow the spreadsheet. That's just unfortunately not how it works. However, as tools, these things are incredibly useful because this is the kind of thing where we can understand other versions of the language of those life problems and go, okay, I do have to make this work. I am going to stop working. I don't want to go to this job every single day for the rest of my life, whatever. And what are some reasonable approaches where I'm hopefully not going to shoot myself in the foot when I start to spend this money? So can't mistake one for the other, as you just said, but we do need the tools to help us with the language for thinking through something that it's not intuitive. There's not a lot of things in life where we get to go, oh, I can make a decision for the next 30 years. No problem. Like how many things in your life can you make a 30-year decision on with high levels of confidence, Jack?
Basically nothing. Yeah, I don't know. What do they say? Death and taxes, or I don't know what you can, and even that taxes changes, so you can't make any decision on that either.
Yeah.
So, yeah, there's really nothing.
So this is the amazing part about these rules and all this stuff is they're good as methodologies for describing the thing, but they're not going to give you the answer. They are just going to help give you some guidelines and guideposts on how to think about a reasonable approach to coping with the reality that, yeah, death and taxes all the way down.
So let's just look at this what Bengen did at a high level. So the idea is he tested from 1926 to 1976. He assumed a 50-50 stock bond portfolio and a 30-year retirement. And we'll get back to those because some of those may not be great assumptions given where we are today. And then basically what he was trying to figure out is how much could you withdraw from your portfolio, adjusted for inflation each year, relative to your starting amount, and not run out of money. I mean, is that basically a high level of what he did?
That is basically a high level of what he did. And again, in the 90s, a great financial planning question and a great observation that you could use the 30-year period. You had maybe not a ton of years in the real world to run this against, but you had a decent amount of years. It's not like he was doing this and the United States of America had just declared independence and whatever else. It was a great way to take a conversation that was happening in the financial planning community and actually put some numbers to it. Are there any of those nuances inside of those things that either like bother you or you go, hey, I have thoughts on this?
Inside of the assumptions?
Yeah, just curious, like as a quant, like how's any of this strike you in questionable ways?
It strikes me like we talked earlier, like as a general rule. And whenever quants start digging into stuff, I mean, like the assumption of a 30-year retirement is probably not valid anymore. We're living longer. It's going to be longer than that. So anytime you get into those details, like as a quant, you can find holes in it. But again, I think if we think about this just coming on the scene relative to nothing being there before, it's actually a big addition. Because now, like going back to what I said before about my family member with the raw assumptions and a general guideline, like there's a lot of value in having that general guideline relative to just, I have no idea like what's going on before I start doing modeling and stuff. I have no idea, like giving someone just a rough guideline, because, when you talk to people and you do like this kind of stuff, I do like the detailed analysis of everything. Like some people don't want to hear that. Like a lot of times people want to hear the very simple, like just give me something basic that kind of gives me a general idea what I should be doing before you break down all these other variables. And I think that's why this was a really good addition when this came on the scene.
You're telling me people don't want to just hear about the numbers, Jack?
I try to find people, Matt. I try to find friends and other people who want to dig into this stuff with me. But you end up talking about bands and stuff when we do it. Like I can't find too many people who are that excited about it.
Well, and so this is the part of it. This is also like the translation mechanism of you have this idea, you have a rule of thumb, you can go do math about it. That's why my entire job exists, and that's why people like you exist to help us. What about, I'm curious on your perspective on this, like the 50-50 mix. Bengen comes up with this because in the 90s, this is kind of the beginning of the acceptance of the 60-40, starting to be with basic mutual funds and soon to be fully implementable with ETFs. I feel like even the 50-50 mix is kind of a product of its time. How do you think about, can you put yourself in 90s brain and like think through that at all?
Yeah, I don't remember too much about the 90s, but I mean, I think behind that it's really important to think about what's going on behind that, which is there's this balance between growth and sequence risk. to some degree at least. So sequence risk is obviously the idea that I don't want to be, when my portfolio is down, I don't want to be withdrawing money because that increases my failure rates a lot. So if I invest 100% in equities and I have the major drawdowns and I get bad luck, I retire in 2008, I'm pulling out money when the market's down, my failure rate goes up dramatically. So, but I need the equities because I need growth. Like 100% bond portfolio, there's been work around this, like does not sustain a very high withdrawal rate. Bonds aren't helping with the inflation, the returns are lower, so that doesn't work either. So it becomes this balance between growth and sequence risk. And the 50-50 was one way to do it. I mean, I think people are more weighted these days towards equities in general. I mean, I think you see more 60-40 and 70-30 type stuff these days than maybe you did then. I don't know. You can correct me if I'm wrong with that. But that's the general idea, is we're trying to get this trade-off right. And if I'm unlucky and I retire at the wrong time, I need something to protect me. Or we can talk later about variable withdrawal strategies and other things you can do for that. But I need that, but I also need growth. I mean, I can't go put the money in T-bills and sustain a high withdrawal rate. I mean, as much as people look at T-bills now at 5% and think, oh, I could sustain a 5%, that's not the way it works. Those don't adjust for inflation. T-bills aren't probably going to always stay at 5%. So at some point in my retirement, they're going to be 2% or something, and they're not going to be paying me what I need. So that's the idea, is you've got to balance those two competing interests.
A great way to think of this, and this is just, I'm going to insert some of the math in it, but that point you made about, how'd you just say it, with the balancing the sequence risk versus the withdrawal amount? Is that the way you just put it?
Well, I was saying balancing sequence risk against growth. And also you can think about it as balancing sequence risk in terms of against the ultimate value of my portfolio in the long run. I think if I was going to run a bunch of simulations and I was going to look at just the ending value in my portfolio, and I was going to take all those simulations and I was going to average out the ending values to say, I just want to maximize the average of what I'm going to get in the long term, you'd want to have lots of equities in that. But you'd also have a bunch of zeros that would be a part of that average. The thing that would happen, though, is the really huge numbers in the best case scenarios would offset those zeros and your average would be drawn up. So if I was really just worried about growth, I would invest in equities. But I can't just worry about growth because, unfortunately, zero is a bad outcome. If I'm living off this money and I need this, for my retirement, zero is a bad outcome. So I've got to make sure I minimize to some degree the chance of that zero. Maybe I can't make it 100% chance that I'm not going to get the zero, but it's about balancing that against the growth, I think, is the way I would look at it.
Yeah. This concept, and this will probably keep coming up over and over again, is it's the surplus or deficit against the growth that's going to drive a lot of these results. And so just the basic sequence of returns, like math problems, it's like you have the 10% drawdown, you need just over 10% to get back to even. But you have the 50% drawdown, you need to double your money to get back to even.
Right. And if I'm withdrawing at that same time, that's where I'm really in trouble.
Yeah. And one of the classic failure examples out of these studies is it's basically if I'm drawing out 4% fixed against my starting value, so $40,000 against my $1 million a year. So now I have the 50% drawdown, so my $1 million turns into $500,000, but I still took $40,000 out, which isn't a 4% withdrawal. Now it's an 8% withdrawal. And so now I'm at $460,000 or whatever going into the next year. And I don't just need $100,000 to get, or 100% to get back to break even. I need 117 or 120% or something like that to get back to break even. Against the drag of that 40,000 withdrawal going forward, that's not only a tall order, that's all of a sudden a lottery ticket to get me there. So this idea of the surplus or deficit against growth becomes kind of the fundamental question in all these strategies and how we translate them from rule of thumb to real life. Another part of this that I think counts for you in particular, and you can explain this probably better than I, is this failure rate thing. So put the quant hat on for a second. Can you walk me through what a failure rate is in these, how you would define them?
Yeah, so the idea is we're doing Monte Carlo simulation here. So what we're doing is we're looking at a bunch of variables. We're looking at all the different market returns in history. We're putting them in different orders. We're just doing a bunch of simulations and saying what happens in this simulation. And so what I'm trying to avoid, failure rate, effectively, like most people define it, is I don't have any money left, which is not a quant concept. That's a pretty easy concept for people to understand. There's nothing left in my bank account. So I'm trying to minimize that failure rate. But for people like you that are planners, it's to do that to 99.999% confidence. Well, I've got to take the pedal way off the growth to do that. And that's probably not an optimal portfolio. So I have to live with some degree of failure rate, like living with, and also we don't know if the past is going to predict the future. So even if I got to 100% success rate, something could happen that never happened before and I fail anyway. So you almost have to accept some degree of failure rate and retirement planning. And then it becomes a question of how much I want to accept. And again, this gets to what we're going to talk about in a little while, which is my ability to adjust is also going to play into this. Like I can accept a higher failure rate if in the case of failure, or where things don't not failure, but things don't go my way initially, I can make adjustments to prevent that failure. So I think that's the idea. And I think a lot of people, I don't know how you guys do it, but I think a lot of people like this idea of like 90% confidence, that when they do these Monte Carlo simulations, I want to have, no more than a 10% failure rate, but you could probably explain better than me on that one.
Go to the grocery store, pick out your hamburger or your whatever, and you do that thing where you're like, okay, it's 90% fat-free or 85% fat-free or whatever. This is not a judgment on the healthiness of your ground meats. But it is to say like 90% fat-free is 10% fat. And a 90% success rate is a 10% failure rate. And that's a pretty great thing to aim for. But there's also the reality of like an 80% success rate with a 20% failure rate. Those 20% failures, what really you have to understand is like the grading of those failures. Just like you might want a steak that's got some really great marbling in it or something. Sometimes you want higher fat content for what you're doing or you're cooking or you're making. The difference between whole and skim in something is a big difference, and it has to do with these things. So when we're talking about growth, we're talking about portfolio survivability against a plan. A larger failure rate, and again, not larger like 80% failure, but a larger failure rate like 90 to 80 might be the difference in saying funding a more desirable lifestyle. But those failure rates, what we're trying to do, and this is generally true once you get like north of like honestly north of 50%, but really north into the 60s, where you start to go, that failure rate's probably not all going to happen at once. So the question is, as we get higher and higher up, where the failure rates get smaller and smaller and smaller, you tend to get closer to that point of time where you go, the failure won't occur all at once, most likely. It's going to occur in stages. And so as I start to see those failures starting to stack up, or the things that could be problematic, what amount of time do I have to actually start to make adjustments around that? Because at the core of all this stuff, it's planning for more things to happen than actually will happen. And in many cases, planning for more things that, I don't want to say that can happen or could happen, but planning for those things and go, if we start to catch ourselves off this track, how are we going to course correct? And that can mean a million different things. It can also mean good things too. You can course correct on spending in the good way, or you can go, oh, I have a giant windfall because I was willing to accept that higher failure rate to start. How can I make some hay out of this?
Yeah, your example of the meat was good because like the severity of what the failure is, like we can talk about failure rates all day, but the severity of what the failure is a huge thing. Like for instance, with the meat, if I told you there's a 1% chance there's flesh-eating bacteria in the meat, you're not eating the meat. Like a 99% success rate is pretty good, but it's not that good when you got something like that on the other side of it. So it really is, what's on the other side of the failure is like a huge thing.
It's the whole like, don't eat the batter thing. And my entire life, like, you make something with like delicious batter, you're going to eat some of the batter. And probably like 2 or 3 years ago, for the first time in my life, I ate some of the batter making, I don't know, banana bread or something like that. But I ate some of the batter and it ruined me. Like it was like 24 hours of, I thought I've had like food poisoning or whatever before. I had never experienced that. And I got to say, I haven't eaten the batter since. So yes, you need to understand what these things are and the severity of the outcome. And you can't talk about failure rates without it. That's one thing in the financial planning process that's really important, talking about, and somebody might have that reaction of showing them the initial analysis where they are like a 65% success rate or an 80% success rate. Like, why isn't this 100? Like I have to get it to 100. And it's like, well, no. I mean, we can show you what we think gets you as close to that point as possible. But more importantly is like understanding what opportunities, what are the trade-offs, both positive and negative, that come along with that thing. Eating the banana bread batter is delicious, but now I am uniquely in tune with how negative that the negative failure rate can be on that experience.
And I want to talk about the things people can change because I think that's important. But first, I did, in researching this, I did find out one thing I didn't know, which is I'd asked you before about this idea of like how does taxes play into this? Like, because we had talked in a previous episode about somebody who had their money in a taxable account, so they didn't have to pay taxes on the withdrawals. And Bengen actually did do a little research around this, and he had revised the safe withdrawal rate to 4.5% if the portfolio was tax free. So he did do some further research and accounted for the fact that if you do have money that you're not paying tax on the withdrawals, you could probably get a little bit higher withdrawal rate, which I thought was interesting.
And again, this is like, it's a fairly intuitive thing. It's 4.5 for tax-free and 4.1 for taxable, right? Is that the right math?
That was his revised research. So I guess he knocked the other one up a little bit as well.
Yeah, so remember, he's talking about that over the whole time horizon. So it's funny, you're like, oh, okay, like 40 basis points, 4.5 to 4.1. Like, what? That doesn't seem like that much. But he's also talking about like the average realized tax rate over a multiple year time horizon. So there's a different shading to that. But again, obviously, if there's the friction of the money coming out before I'm consuming it, yeah, it's going to be, you at least know intuitively it's going to be a different number. It's interesting in the study that number is probably smarter than most people would guess, in the sense that it's about a 10% differential as opposed to like a 20 or 30% differential when people think about normal income taxes.
It gets back to the idea that this is a rule of thumb. So everybody has different mixes between Roth IRAs, traditional IRAs, taxable accounts, and that whatever that mix is impacts this to some degree, but it doesn't impact it so much that it's like, your withdrawal rate's now 8% instead of 4%. It affects it a little bit around the edges. So the rule of thumb still works pretty well. Like, obviously, if I said to my family member what you can withdraw and the real number is 4.5 instead of 4, that doesn't really change much. It's still a good rule of thumb, but like when you get into the details, then you can refine this more.
Yeah, and a lot of this stuff shows up at the end of the thing too. This is where we know from the data that a lot of people who have followed a version of the 4% rule, whether post reading this paper or just because how they spent their money over their time horizons. We work with a ton of these people. You've probably met a ton of these people too, where it's like they just have accounts that have ballooned over time. They've earned more money on their savings than the money they've took out or spent, and now somebody's getting an inheritance or something else. And this is the other reality. If you consume below what is actually done, you end up with a gift, either as an inheritance or something else, but it's a gift that has to go somewhere. And if you err on the side of conservatism, I don't want to say caution, but like you err on a slightly more conservative measurement of your risk appetite, then guess what? The chances of a ballooning gift at the end of this become more and more real, because this is where those basis points can really add up.
Let's talk about some ways we can adjust this, because obviously, as we said, in the real world, it's not just take your 4% and move on with your life. Like, if you can make some changes, if you get the bad outcome, then you can actually sustain higher withdrawal rates. And one of the things we found in the research here is this study by Jonathan Guyton, who said that over a 40-year retirement, even a 100% stock portfolio could sustain 5.8% withdrawal rate with a 90% success rate by using decision rules to adjust withdrawals. And so this is where we're getting into variable withdrawal strategies. And at a basic level, it's if the market goes down, if I get the bad outcome, can I take out less money? And so the person who's relying on this to pay their mortgage, to put a roof over their head, to feed themselves, and has no leeway in there, is a different person than the person who has to swap out the Maserati for the Honda or something if things go wrong. The person who, at least in theory, unless they consider that an essential part of their lives, the person who has to sell the Maserati is still going to be fine. They have the ability to adjust their withdrawal rate. They can sustain a higher initial withdrawal rate. The person who absolutely needs the money and cannot adjust their withdrawal rate can sustain a lower initial withdrawal rate. I mean, I think can you make changes is an important question to ask yourself when you think about what your initial withdrawal rate is going to be.
The question of can I make changes to the withdrawal rate always comes back to what are my needs for this stuff. So now we're talking about like the consumption problem. And if there are expenses or things you can cut, if the difference is, do I keep Netflix or cancel Netflix, no big deal. If it's, can I afford to pay for this school or that for my kids, or can I afford the house I live in? Like the stakes change on the side of these things. What's really interesting about the Guyton study is that, taking more risk probably doesn't blow you up, because most of the time equity markets don't have 20 or 30 year periods that actually suck. There's some interesting data. Wade Pfau did remarkable work on looking at this around the world. So there's some US bias. There's definitely some historical average bias. There's a bunch of things inside of these numbers that are problematic. But the reality here is if you take more risk and you don't have that 10% failure where over a very short period of time you blow yourself up, which is largely dependent on if I can change my lifestyle around these things, if I can have some decision rules to help adjust my consumption, the odds of an upside skew are just that much greater. Kind of remarkable too, because if you think about it, crude math here, but just like 4% to 60%, that's a 50% increase in your spending. That's the difference between being able to spend $40,000 a year and $60,000 a year on that $1 million portfolio. Those are real dollars. That's a real difference in lifestyle. Multiply that up by a couple orders of magnitude and you go like, oh, that's how people can do this.
And what's cool about these variable rules is, like you said, they work in both directions. So it's not just like if I get the bad outcome, I've got to be willing to cut. Like if I get the good outcome, if I retire at the beginning of a massive bull market, as time goes by, the sequence risk becomes less and less. I've got more and more money than I expected. Now I'm actually getting a raise. Like I'm taking more and more money than I thought I could take. And so it's cool that it kind of works both ways. It's not just one of these things that you're only worried about on the downside.
You can think about these, and this is like on the failure rate side of this from. It's always, can I spend less or where am I going to take it from? So one of the common conversations we really like to have in the years leading up to retirement is, number one, how much money do we need in, sometimes I call it the war chest. Sometimes I call it, basically it's like, it's not the piggy bank. The market can't come and break this thing. We need it something where we're going to probably accept little to no return. Kitsis has written a lot about this too, but it's the place that basically when the markets suck, what are we comfortable with pulling from? Because depending on the degree, we can adjust lifestyle great, but the other with the variability is like, is there a place we can take it from so that we can give the market stuff time to recover? It's a big part of, like at some point we talk about everything in terms in like risky stuff and risk mitigation stuff. That is the beginning of separating this thing. It's very much like an endowment or a pension or a liability driven investing type world where these words come from. But it's this idea of going, okay, can I either spend less or can I choose a different place to take it from to give my risky stuff time to recover? That has massive ramifications on retaining that upside skew over time. Because back to the Guyton study again, if I'm taking more risk, but I have variable with strategies to not have to consume as much during a downturn, I actually keep a lot of that right tail still on the table, even when I go through some ugly periods. And those are some pretty impressive numbers in that study, not gonna lie.
Yeah, and Kitsis found that if you were willing to do that, you could sustain a 5 to 6% withdrawal rate. So again, going back to the same thing Guyton found in a different way, by being willing to adjust or being willing to not sell equities in the downturn, I'm sustaining higher initial withdrawal rates. And I assume if you were willing to do both of those, maybe you could sustain even a little bit higher withdrawal rate. And I have to assume, I was going to ask you this, but I have to assume like in the real world, this is how it works. Now, I don't think you're going to people and being like, for your retirement, we will be using the Guyton-Klingler, guardrail rule or something. But in the real world, you're just doing it. Like you're looking at the situation you're getting and saying, you know what, you could probably take a little more money now, or you know what, you might have to take a little bit less money. Yeah, I think that, this whole, like, we're withdrawing the same amount every month is probably not what's happening. Not to even consider things that could happen in someone's life, a medical issue or something. But also, I would assume we're looking at what's happening over time, and we're saying to a client, you might have to withdraw more, you might be able to withdraw less, whatever it is.
And knowing it's a moving target, the key thing, and yes, we're never going to, like, talk about the Guyton, whatever. We're never citing 3 researchers in, like, the explanation.
People don't want to hear that.
Yeah, and in the same way, like I want my doctor to say, take the Tylenol or whatever. Don't give me the acetaminophen, blah, blah, blah. Like, don't give me the Latin derivation of the name.
Or in my case, like the Sortino ratio or whatever. Like, nobody wants to hear about that.
Yeah.
Nobody knows what that is. They want you to explain in the real world what that actually means and not use the terms.
And it's important for you as a practitioner to be the person to know that stuff and have the understanding. It's not important for them to understand what actually has to be implemented. The reality of in the real conversations, and make this point very clear, when somebody's 5 years out from retirement and we're having the conversation about shifting from accumulation to decumulation, about shifting from being able to save balance assets onto the balance sheet versus the need to consume off of the balance sheet without that money going in, we talk about both sides of the skew. We talk about, guess what? Well, like I worked with people like in the financial crisis who had just retired, or actually a lot of people who got laid off in that period. And oh crap, what do we do? Forced into this spot or in this thing, I've got a downturn and I need money. So try to talk people through these two tail scenarios. If we make this decision, we start this process and we get punched in the face right away, what are we going to do about it? What are some realistic things to talk about? That's the negative event, especially quick on. The other event, though, that I will regularly have people psychologically work through with me is, okay, now on the good side, we get the positive skew. You're spending this much money, but you're not spending more. And the account balances are actually booming and ballooning. What are the other things we need to know? Is it the midlife crisis car you never got to buy? Is it the extra beach house? Is it the other stuff? When you get a series of above average results directly in a row, what do you want to do about that? Do you want to bank more safe retirement years and know that that's where the profits need to come off the table and go into those risk mitigation assets or into the war chest or whatever else? Or is that the thing where you're like, you know what? We always skipped on buying the Cape House or whatever it is. And now has that positive growth actually funded that thing that gives me some greater sense of, satisfaction? Because money's not just there for it's not just the points on the scoreboard. Like it actually, like winning the game means something, not just like tracking the points.
How do the withdrawals, like, how do you see them in the real world? Like, do most clients have like an automated amount that comes out of their account every month and then they'll talk to you if they want to adjust that? Like we have some people that are like that. We have some people who tell us at the beginning of the quarter how much they want for each quarter, like on every quarter going forward. And if it's something outside of what we planned for, we talk about it then. Like, how do you see like the withdrawals in the real world?
So there's layers. And I think the industry loves the 4% rule glosses over the reality of the layers. 4.5 versus 4.1, depending on if you have tax-free or if it's, a taxable account and all these things, or a tax-deferred account. We gloss over the layers. So the reality is, and let's just say you're a mid-70s like retiree, you're already in RMD age and all this stuff. You're getting Social Security. So just think about it like this for a second. So somebody says, I need $100,000 a year to run my household. So first off, we want to understand the fixed versus variable expenses on what it takes for them to run it. But then we start to layer in the different types of income because a lot of this is outside of the 4% just applies to one part of the portfolio per se. So you got Social Security coming in and you go, okay, now I'm starting to match up liabilities or the stuff I have to pay, stuff I need for consumption and income I have coming in. So it's like, I have this much I need to spend. Here's what's coming in. Okay, Social Security. Well, that's a fixed amount indexed for inflation. I know what that is. RMD. Well, that's a fairly, like we can at least run the numbers out on the life expectancy tables and what the IRS says. And now that gets us to here. Then we might have dividends, interest, and other stuff. And we can look over the prior tax returns and 1099-Rs and Is and all that crap. And we go, oh, like, okay, this gets us to here. Before we even get to the actual proactive distribution of an amount and what that percentage should be, we have to stack all these things against each other, the fixed and variable expenses and the fixed and variable pieces of like income in those sources. Most people we work with like have some amount of assets and this part actually fills up pretty fast. And then we get into the reality of how far is that gap? How much do we have to close? Or in the other direction, how big is that gap? And do we need to consume more or rethink the gifting strategy? The layers in the real world is where all the actual work happens. And most people, you settle into some routines around this stuff. So the other reality is like most people, and this is where the retirement conversation really needs to happen 3 to 5 years in advance, because you got to be rethinking what those new routines look like. Once you understand those new routines, in most cases, people are going to play those out over like 3 to 5 year stretches on average before stuff starts to happen. Part of our job then as the planner is to sit back and go like, okay, I'm observing this routine is changing. You're going to Florida more often, or you're doing this other thing. You had the giant windfall in the markets, but then you bought the second home or whatever else. Now, how is that going to change those fixed and variable expenses? And then is this a 5-year phase, or is this like a 15-year new way of life that's going to upend the entire thing? The layers is everything.
That RMD point is really important because if RMD is something you have to take, So if RMD plus Social Security is more than you need, then there's really not much discussion to be had around withdrawal rates or whatever. If that's above what you need, then you're getting more than you need, just through what the law is saying you have to do. You don't have to worry about like all this other variable stuff.
Yeah, and the IRS, they're not, I don't want to say they're not dummies, but they're not dummies. Like, there's actuaries who come up with these tables and do this stuff, and it kind of rhymes with this reality. The RMD math is historically pretty favorable, and that most people on the RMD schedule will still pass on whatever with a balance in those accounts. The required minimum distribution does not in current form exhaust the amount in a retirement account. So Social Security plus RMD plus your dividends and interest gets you further than that fixed and variable expense. Like, sure, you can go calculate the 4% withdrawal rate to your heart's content. It might not matter. That type of, it's almost a variation on the way people think about don't touch principal, just spend your dividends and interest. Like Social Security plus RMDs plus dividends and interest and any other quote unquote passive income that you don't have to do anything for, but is automatically going to happen or is forced, you're compelled to have happen in some way. That can be a really great rubric for just right setting your expense profile for your retirement years. That works for most people pretty darn well if they can get their lifestyle in line with that amount.
Yeah, and you think, by its nature, the government has to be conservative in these RMD things, because what the last thing they want is like a bunch of people, like 80-year-old people exhausting their retirement accounts because the government, forced them to take too much money out. So by definition, they're going to be conservative in terms of what they're going to force you to get out of there. They'd much rather have a situation, they want you to have a balance at the end versus like trying to draw every dollar of tax out of there that they can.
Which is exactly why they decided to predominantly put the 10-year rule on the distributions for inherited accounts, because the math is deliberately conservative on the front end. And this is not in defense of paying or not paying taxes on retirement money, but the reality is the 10-year rule that's predominantly enforced for most inherited retirement accounts, so like non-spousal inherited IRA accounts now have a 10-year rule applied to them. And we've covered this in another episode, but it's based on this idea. Most people, if they follow the normal rules, will not exhaust the account. That means that account was not distributed, but met the purpose of the person having enough money in the retirement thing. That is by design to help offset the retirement crisis, which has been a varying levels of crisis in the last 15 years. And that's the reality of it. The 10-year rule is basically to address that and say, great, you saved for this money in your lifetime. It got you through your lifetime. Now that it's not going to a spouse or somebody immediately that the tax code is not basically designed to like have you help them any more than a spouse. So now, whether it's your parent or whether it's your kid who passed away and you're the beneficiary, those rules apply to basically say, this is outside of the scope of the otherwise conservative nature of addressing the retirement situation in our country.
So there's two more things I want to ask you about. The first one is kind of rare. I mean, we've seen it very rarely, and you probably do too. I mean, most people who come to us or you are doing probably fairly well in terms of saving for retirement. But I want to ask about this idea of unsustainable withdrawal rates. So, what happens if someone comes to us and says, this is what I need, and that's 10% of their portfolio or something? That's not something in good faith we're going to sit here and just say, all right, fine, take your 10%. I mean, we've got to understand, that has a pretty high failure rate, or I assume an exceptionally high failure rate. Like, how do you think about that situation and how you handle that?
Our job is to have hard conversations as much as our job is to put the cherry on top of the easy conversations. So if somebody comes and they have a 10% withdrawal rate or more, they have a 20% withdrawal rate, and there just aren't the assets to support it, our job is to say, this bridge is probably not safe to drive your car over. That's not always a fun conversation. It happens probably more regularly, and I think more people would probably be surprised with how many wealthy or high earners actually have unsustainable savings rates, and then that produces unsustainable withdrawal rates as they get near retirement. That's not to say these things can't be fixed. The more money you have or the more money you make, the easier it is to basically have your, oh crap, I need to fortify this moment. But the amount of people who have unsustainable lifestyles and therefore translate to unsustainable withdrawal rates, like that is a hard and very real conversation that many people get into sometime in their 50s. And I say it this way because I think it's really important that we normalize this. it's very, very common. And we've had episodes where we've talked about like peak earning years and everything else. So the average American is going to get married, have kids. Those kids are going to grow up, go to school. Oh, they're going to buy a house. The kids are going to grow up and go to school. And usually sometime in like the mid to late 50s into the mid to early 60s, you start to have most of the kids are through school, out of the house. And if you haven't moved 18 times and refinanced because rates were zero, ideally, you've got some equity in the house and you're in your peak savings years. This is that part where people start to go like, holy crap, life is pretty good. And the question becomes, life is pretty good. Am I refocused on saving or making it to retirement? Or is life really good? And yeah, we're taking 3 times the vacations at 3 times the expense. And now we're taking all 4 kids with us to, South Africa on the private jet to do whatever. That lifestyle and figuring out if it's sustainable, it's our job to say no if it's not in an honest and empathetic way. And then it's our job to also say, like, what are some constructive ways that we can pull this in line? And that means we're taking what we have to work with on this side against what the variable and fixed expenses of what's reality are on this side. And we're saying, where do these things cross? And then you, Mr. and Mrs. Client, it's your money. How do you want to think through this thing? Lifestyle creep, more expensive life. You have windfalls, like people spend money, especially when you're younger and you're not thinking about this stuff. It's super, super real. And it can lead to very hard conversations, but they are critical and important conversations. I like to think that's a big part of why the financial planning industry exists. Not to have the easy conversations, just take this much out and here's when to turn on Social Security, but to actually say like, okay, yeah, life is actually kind of complicated and more money, more problems.
Yeah, and I think that's where we can add value. I mean, I think like some advisors will shy away from that. They'll be like 10% withdrawal rate. It's not gonna work long term. I don't want to be a part of this like train wreck that's going on. But the reality is, like you said, you can help. We actually had we had an 8% withdrawal rate that came to us at one point that we took as a client. And, we were able to help, first of all, like you said, what can you do in your life? Do you have things you're spending money on that you don't need to spend money on where we can cut that down? What can we do with your portfolio to help you? And, and in this case, talking through the potential future things, this person ended up having an inheritance that came eventually that cut that withdrawal rate in half. So we were able to help them along the way. Eventually, they get the positive outcome that, was somewhat foreseeable in terms of, an inheritance that came. It made the thing better. So, I mean, my view has always been like, let's try to help along the way versus saying, let's look down on this person. How could you possibly have this 8% withdrawal rate? We want no part of that. That's the way I've always looked at it.
I'm saying periodicity because I don't know a better word to use for this right now.
You know our 6-syllable rule in the podcast, Matt.
I'm violating it heavily. This is what I get for reading a bunch of academic papers before we jump on to record. The idea of like, we have, again, these phases. So there's some really important life transition literature. Herminia Ibarra is like the gold standard on this stuff for her work. And it basically says it takes somewhere between like 5 years on average, or 5 years to change anything in our life, about 3 years to do it with an identity shift. Retirement, things like that are definitely identity shifts. And as people, we can kind of look at these things and understand how we go through phases. And usually a phase is something that lasts a little more than a year, maybe 2 years on the shorter end, and like 5-ish years to make any big changes on the broader end. It's not uncommon, especially with people who are higher earners who are deciding to retire early, or there's certain things when we see those, the point you just made, when we see those higher withdrawal rates frequently, and I see this in the profession, people are like, oh, you can't do that. You can't take 8% out. That's crazy. Our job is not to be the wall that says wrong, dumb, paper and spreadsheet, like beat you with the calculator. Our job is to say like, okay, like, what are we going to do with that? It's the whole like, well, you got some duct tape and a pencil and some tinfoil. How are we going to fix the rocket? Sometimes you don't know how it's going to get fixed. You don't know if that inheritance is going to come in or not. But sometimes you have to say like, we're going to make as good a go at this as possible. I know I've told a couple of these stories before around this thing, but a lot of times you're planning for something that then doesn't happen the same way, or you're planning for something, and that could be an inheritance. That could be a change in tax policy that changes your healthcare costs. And all of a sudden you've got a balloon savings account that was supposed to pay for one thing, but now it's just there. and now you get to use it for something else and let the risk assets run or whatever it is. These pivots and how the world actually unfolds in front of you, the sequence of returns and everything else, good or bad, can sometimes mean you did something with an unintended consequence somewhere else, or another thing comes in and halves it. Our job is not to be the wall where we're all spreadsheet and no real life. Our job is to actually be there's a wall there. If you're running into it, we need to address it and say, what can you do to be smarter with this? Or how many times can you survive running into the wall? But then also, like, how do you make best use of it? When that client came into you guys, was it just a hard no, this is stupid, what are you doing? Or was it, well, if we keep on this path, this is when you run out, but we'll help you the best way we can till it runs out? What was your attitude?
The first thing is, the front thing has to be education. You first have to make them understand that, in theory, this is not a sustainable withdrawal rate. I mean, you don't want to just like start doing stuff and like have them think that's fine. But by the same token, you've got to say, all right, how can we work together to make this better? This might not be something that's sustainable for 30 years, but it is what it is right now. How can we make this better? Like in this case, they had the inheritance. What might happen in the future that'll make this better? What can we do with your spending? How can we allocate your portfolio in the proper way? There's so many things you can do to help someone like that. And like you said, I don't think we want to live, all of us live in practice, not in theory. Like, it's great for me in the quant world to be like, in theory, all this stuff happens and people, stay the course in 20 years of value drawdowns and stuff. But that's not the way it works in practice. It's not our job to judge people. I mean, I have my own, certainly, behavioral issues in my investing. I'm sure you do. It's like, we're not perfect either. Like, there's no reason to be judging people. It's like, how can we take the circumstances we're dealt with, how we've been dealt, how can we make it better? How can we do the right thing from where we are versus saying, like, I want no part of this? I mean, to me, that's always been the right way to do it.
This job is only fun because nobody knows the answers. That's the best part about this. Even the person who comes in with the unreasonable withdrawal rate, you have to have the honest conversation about why this is unreasonable and start with education. I agree with that wholeheartedly. But then the important part is you don't do the other side of the thing. It's not like this client came in with this thing and that's the IUL policy that bought me my boat. Like that's the thing. The interests are the practical side of we have to solve this problem, not the theoretical side of this is some hard and fast rule. Because at the end of the day, it's going to boil back down to, is this a surplus or deficit against growth? And there's more paths out of this stuff than usually we give credit.
So the last thing I want to ask you about is leaving, on this part at least, is on leaving money to kids. Because we just did a podcast that came out today with Rick Ferry, and he was talking about this. Like he talks to some clients who are like, you know what, I want to make sure I don't run out of money. That's my priority. He talks to other clients who say, you know what, I'm giving you $2 million. Like, I want to try to leave that $2 million to my kids. So, that might dictate a little more of a growth mindset or might not. Or some people say, like, my really goal is I'm willing to live with, some losses on my own. I really want to give a lot more money to my kids than I come. Like, do you see that a lot in terms of like that balance between, on one hand, I've got to, sustain my own lifestyle, but on the other hand, I do want to leave money to my heirs and I want to grow it for that purpose.
Consumption and gifts, the Peter Medina episode from however long ago that was, like rule number one is you're either going to consume the money, spend it on something, or you're going to give it away. And so when it comes to kids, when it comes to charitable foundations, when it comes to all these things, there are lots of totally viable things that are not part of your consumption plan. Where you draw the line on, do I still need access to consume this if I have a healthcare event, if my spouse does, if something else happens? Where you draw the line on, is this earmarked for consumption or is this earmarked for gift, has a lot to do with this exact purpose. And the question is going to become, if 10 years down the line into this commitment to, I want to make sure each of my kids have $1 million or something like that, the commitment to giving that gift is the question then, if I'm committed to that and something else changes in my own expenses, my own lifestyle, am I willing to take some of that back? Am I willing to say that's no longer a gift anymore, or is this as important? We see this a lot. This is a big part of more advanced estate planning because you're actually starting to plan for multi-generational wealth and what gets passed on and how, especially around like tax rules and other things as well. Just stuff that takes more advanced planning, you get into this. The key part for most people, though, is just understanding the rigidity that you're going to apply to this. Is this truly something that has to be defended at what priority stake against everything else? And do I really understand those priorities so that when the crappy thing happens, when a spouse dies young or a spouse needs an advanced directive for care or whatever else, can we afford it and still do the other thing? And do I understand that prioritization so it's not a torturous event?
So the last thing I want to ask you about is this idea of capital market assumptions, or, obviously if I'm starting retirement at different times, the valuations of stocks can be different. The yields on bonds right now can be different. My expected returns going forward can be different. And the question becomes, like, I think it's kind of a balance. Like, how much do I take that into account? On one hand, you could say, well, there is research that shows, if it's 1999 and the CAPE on the S&P is 45, my forward expected returns are lower. But then there's also the idea that, a lot of these expected returns deal with, a 7 to 10 year time frame. And a lot of times I'm retiring for a 30 to 40 year time frame. So some of that's going to, go into oblivion over time. So I may not want to care about those as much. So how do you think about that when you're thinking about 4% and sustainable withdrawal rate? How do I think about where the market is today, what bond yields are today, like how attractive these assets are long term?
So for us, number one, you need capital market assumptions to build any portfolio. To actually do the portfolio math, you need capital market assumptions. You need to know your expected returns. You need to know your average returns. You need to have some assumptions about correlations. This zigs how much when that zags. You have to have an understanding about why you're building a diversified portfolio, or why you're not. If you don't want one, or if you think all the math is crap, okay. I am of the camp that you should at least have a logic, even if that logic is flawed, for putting together an asset allocation strategy and doing this. A big part of that is understanding the assumptions inside of what you own for what do I need this to do? Gifts, consumption. If I'm consuming this thing and I'm applying some type of 4% rule for it, the first thing I really need to know is when in my failure scenarios, the thing that I'm pulling from, if it's not going to earn me at least the 4% that I need to sustain the withdrawal, how much into the negative am I going to go? And this goes back to that example I gave earlier on. If I have a 50% drawdown in my equity basket and I was taking 4% before, so now I'm taking 8%, I need 120% to get back to my break even before that event. Is my withdrawal going to hamstring my ability to have that recover because I have no other means of recovering it? I want to know that stuff up front. Now, likewise, the more complicated the portfolio, the more capital market assumptions, the more what do we think about different valuations and things do we have to get? You can go to, I'm going to pick on BlackRock because it's publicly and freely available, but I'm pretty sure you can find BlackRocks, you can find Vanguards, you can find all the flavors of vanilla ice cream for this stuff you want if you just go onto the internet and Google it, or companies like ours, we have this stuff. It's built into the financial planning software. It's built into our portfolio construction stuff. We have an investment committee that merits and weighs all this stuff out every single year and then multiple times ongoing to say, where are we at and where did we go with this? You have to understand in those assumptions the withdrawal amount against the mix of assets that you own. And you have to do that test of how reasonable is this? Because even if, and spoiler, BlackRock in 2024 here as I think private credit's the top is the most attractive thing. It's okay, great. You have private credit. Well, you got liquidity rules, you got taxation rules, you got some assumptions that may or may not be lofty depending on the current environment and depending on, what products are for sale out there in the marketplace. So you got to look at this stuff and ask the question, yes, this gets me to my withdrawal rate, but what other risks am I taking on to get there? Even if some of the assumptions in the marketplace are really low. Things are either good enough or too good to be true in most cases. So,
yeah, and I think also the educational part is really important too here. Getting away from modeling and assumptions and all that, just saying to a client, listen, it's Japan in the 1980s, the market is trading at a CAPE of 100. The odds are you're not going to get the 10% return here. And I think in that case for 30 years you didn't get, but that's an extreme example. But the idea of just saying to a client, it does matter to some degree what our starting point is. This may change what happens in the long term, even though we could model it out and stuff, but just understand the market's expensive. We've had a really good run here. That may change what we get in the future in terms of what we can't just assume whatever the average return of the stock market has been over history. We're going to get that because we are at a very expensive period here. And when the market has been very expensive historically, traditionally expected returns have been lower in the future.
I think we see that over and over again. Wade Pfau did a great study on this too, where he basically took the 4% rule, applied it multinationally or internationally, and said, I think it's 4 of 17 countries, the 4% rule works, and it fails in the rest. And you can take a valuation lesson out of that. You can take a wars and political events and other things lesson out of that. The reality is you could have the 100 times cape and stuff maybe works out. But you probably need a lower withdrawal rate. You could also have the, what was Russia's cape going into the whole like invading of Ukraine? Like you could be ultra cheap and you could get screwed even worse than Japan got screwed, because at least you can still survive the withdrawal rate. This is the mess
rule
we're
did not work
dealing
in Russia. It did not hold.
Yeah, it didn't work in Russia and it didn't work in Japan if you started it right at like in the peak boom. However, could the person leading up to the boom have actually put enough in their risk mitigation and their piggy bank and their war chest assets to get them through? Because then you needed the 1% withdrawal or whatever it was in Japan to survive, like going forward conservatively. Yeah, you probably could have. And it might have even still held up in that like 80% stock basket, even with those negative returns for sake of consumption. The math is going to bend your brain once you start stretching it out over all these years. You have to have a strategy you can stick to, just like everything in quant investing.
So we're at 55 minutes, so we'll wrap up here. But I think the big takeaway from this is, rules of thumb are rules of thumb. All this calculations and data, it's just calculations and data. Like we all live in the real world. We're human beings. We make choices. Like a lot of this is to guide us. And I think that's what I've learned in my quant career the most is like when I could use all these numbers and everything to guide us in the right direction, that's when it works really well. When I get wrapped up in the numbers and I start showing ratios to clients that they don't care about, like that's where we get ourselves in trouble. So, and that's true of the 4% rule. You want to, it's a great guide. Like I talked about at the beginning with a family member to say, yeah, am I roughly in the right spot? It's a good thing for that. But behind the scenes, there's so many details we talked about here that actually translate in the real world that it's not something where you can use it as a hard and fast rule.
So in the 90s, when I was playing in a wedding and cover band, one of the songs that was a big hit in the late 90s was this Brian McKnight song, Back at One. Are you familiar with this R&B slow jam classic?
Yeah. That?
Man, we played that at a lot of weddings in like the year and 2 and 3 that was the breakout song. I don't remember.
That's a tough song to sing, I would imagine.
No,
you got a good voice.
That's an insanely hard song to sing. I'm perhaps somewhat not emotionally scarred by. Like even just like doing the count off as the backup vocal is a funny thing. But yeah, no, it's actually a great song. It's got one of the great like skip measure key changes in it. It's phenomenal. I still have a soft spot. I will listen to that song if it comes on the radio. But in that song, if I can, I'm going to apply Brian McKnight to the 4% rule for all the lovers out there. The 1% withdrawal rate, definitely, that's dream come true. If you've saved enough money to not care and all you need is the 1% withdrawal rate, back at one, fantastic, you're winning. 2%, I just want to be with you being my principal still. That's like I haven't drifted that far from not having to disrupt you too greatly. 2%, conservative withdrawal rate. You're still winning the game of love with your portfolio there. 3%, it's plain to see that you're the only one for me because, yeah, you need to actually spend your portfolio to make your money. This also works because that's like that 3 to 5% sweet spot, which 4% repeat steps 1 through 3 exactly because 3 to 5% about the same in the outcomes and results and the failure rate. Then 5% make you fall in love with me. Okay, that's spending on my habits. That's okay. You might be getting a little bit manipulative when you're getting over 5% in your expectations. That's where you got to step back. If you spend the money, this is the fact, you're going to need to go back to saving some money at the end. So if you press it too hard, you're in trouble. But Brian McKnight, I know you weren't writing about Bengen or the 4% rule, even if it was about the same time period. I got to say, back at one, I'm taking all the financial lessons and advice from you, Mr. McKnight. Thank you.
Yeah, and what other podcast are you going to get the 4% rule and Brian McKnight brought together? So I think that's a great thing to wrap up on. Thank you, everybody, for joining us. We'll see you next time.
Hi, guys. This is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.